Hey, welcome back. I want to go through chapter 3 notes this morning that I think are important, and I'm going to call these out so that you can, as you read the book, concentrate primarily on these particular areas. So, chapter 3 is really just getting its introduced, and you probably have heard most of the things that they're going to say, but introduce the different kinds of equities and investments that you can make. So. The first one being, the interest-bearing assets. So a money market instrument. You've all heard of a money market account. It's basically a savings account, a little higher interest rate than what you might get from your bank or your credit union. But these are T-bills, short-term instruments sold by a large company or government, and they mature in less than 1 year. So they're very, very, very low risk. It's essentially, what you put in there, you get an interest rate back that's higher, as I said, than a bank. So money market accounts, if you have in your bank or a credit union, you can maybe use a money market account versus a regular savings account. Typically, you'll get a little bit more interest. So look for that with your bank. The other thing you can invest in is what's called a fixed term or fixed income security. So that's a little longer term debt obligation. But so they're buying bonds that are a little bit longer, and they're fixed in that it's basically the promise. If you buy it, they're going to promise to pay you a certain amount at certain times in the future. So you may buy something for $100, and they say, in 6 months we're going to pay you $5. In another 6 months we're going to pay you another $5, and then at the end of a year we're going to give you your $100 back. So you're essentially, basically, just getting an agreement to pay you for your use, their use of your money. So the best way to invest in that type of a security is through a mutual fund, a fixed income income securities mutual fund, and we'll talk about that when we get into the mutual funds. So those are really your savings type accounts, very, very, very low risk. If you're getting really near retirement, or you have something that's a short-term obligation, short-term savings plan, those are the types of instruments that you're going to use. The other equities, you've all heard of stock, right? So what is stock? Stock is basically the ownership in a company. If I own Disney stock, I'm a part owner of that company. I may have a very small number of shares, so I don't have a lot of impact on the management of the company, but I am an owner of the company. It's a publicly traded company, and I own a part of that. And you can own thousands of different companies out there. And you can own them through a mutual fund, you can own them through stock. So you basically, with stock, you have common stock, which is what you buy and sell on your TD Ameritrade account or whatever accounts you're using out there, and they're what's called regular shares. That's what most of us are going to buy. There's something called preferred stock, which we won't get into too much, but just know what it is. So preferred stock differs, and it differs in terms of the dividend payment. So a dividend payment, a lot of you have heard of that, I'm sure, is if you buy a stock, they agree to pay some percentage per share at different times of the year. The company has the full discretion to pay them whenever they want and how much they want, and they can decide not to pay them anymore if they choose to. So it's totally at the company discretion. A lot of people buy stocks that pay a lot of dividends. Some companies pay them, some companies don't. But on the preferred stock side, the difference there is the dividends are guaranteed. They will pay them at a fixed amount, and they're never changed. So they can turn them off, so they aren't, I guess, guaranteed. But when they say they're going to pay them, they'll pay them at a certain amount. So you can kind of buy into those. And the difference between preferred stock and common stock is if there's not enough money, if the company's not doing well and they're going to pay out a dividend, but they only have so much money to pay out, they'll pay the preferred stock first, and if there's any left over, they'll pay the common stock. That's really all you need to know about the preferred stock side. And not all companies have preferred stock. So with stocks, obviously the risk is the value goes up and down. Each day you watch the trading of stocks. So your stock can go up, it can go down, and the value really there is the risk. How risky is the company that you're buying? Is it a tried and true company like Amazon or Facebook or Disney or any of the Dow Jones stocks, or is it a risky stock, an up and coming company? So that's the value will go up and down. So the benefits of stocks are the dividends. You get paid, maybe 40 cents a share, and if you own 1,000 shares, you get, a check basically in your account for those dividends. So that's a benefit of having stocks. And then again, the value goes up and down, and then we've seen in the first and second chapter that over time stocks tend to increase because companies are out there trying to get better, make more money, be more profitable. So those are the benefits of owning a stock versus our money market account that we talked about earlier. This stock's going to appreciate probably more and faster, or it could go down faster. So there's risk and reward there. So if you want to make more money than just a savings account, stock's a good way to go. Something called derivatives. We're not going to get too much into that, but basically a derivative, is an asset derived from a primary asset, from another asset. So if you just have a stock option would be a derivative. So you have a stock, you can buy and sell that stock. You can buy an option on that, which we'll talk about here, which is a derivative of that original asset. So one of these is called a futures. You've probably heard that in the news, buying futures contracts. Basically what a future contract is an agreement to buy in the future at an agreed upon price. So let's say, airlines do this with oil or gas or jet fuel. They'll go out and say, hey, we'll buy jet fuel 6 months from now at this price. So that's a futures contract. They may do well, or depending on the price of fuel. If they think the price of fuel is going to go up, they'll agree to buy it at a lower price now in 6 months. And if the price of fuel does go up, they've done well there. If it goes down, they're still buying it at that higher price. So futures contracts are very risky. I wouldn't necessarily recommend you get into that until you're a very experienced investor. But may know a broker that wants you to get into those things. And if you think the prices are going up and down, all kinds of different futures contracts. There's another thing called a stock option. So you have a call option, which basically it gives you the right but not the obligation to buy a share of stock in the future at an agreed upon price. And so you can if you think that the stock's going to go up or down, you can kind of buy an option to give you that option to buy it at a future point. You can also buy a put option, which is the right to sell a stock or a mutual fund at a future date, but not an obligation to do so. So you'll read a lot about your options, know what they are. We're not going to get into trading those. It's, again, very risky. Once you get to be an experienced investor, you can start to buy stock options. There's call options and put options, right? Call is the ability to buy. Put is the ability to sell. So we're not going to get too far into that. But we're going to use an example there just to give you a better idea what that is. So let's say you want to buy a car, and you put $200 down, and you say, I'm going to come back in a week, and I'm going to buy that car for $8,000, right? So you've got a $200 down payment and an $8,000 agreed upon price with that car dealer. That $200, if you decide not to buy that car at the end of the week, you lose your $200, right? So that's called the option premium. That was the amount of money you paid for the ability to come back in a week and buy that car for $8,000. $8,000 is referred to as the strike price or the exercise price. So in stock options, you'll pay some amount of money to have the ability to buy that stock option in a week or a month or however long that stock option contract lasts at that strike price. So that car example is a good way to kind of think of that. So again, we're not going to get any deeper than that into these types of equities. I want you to read the chapter. I want you to know what these things are. The quiz will just go over the basics of what they are, probably very similar to what I just talked about right here. So review, maybe come back and watch this before you take the quiz, and these are the things that we're going to be quizzed on this week. So have fun learning about these things, and then we're going to use those when we get into chapters 5 and 6 and 7. Once you get into start buying stocks and bonds, this is all building towards that. So we'll talk to you soon.